A service business can stay busy, win quotes, and still lose money because overhead is missing from the price. The dangerous costs are rarely the obvious materials or field labor. They are the bills that keep the company operating before, during, and after the job. Estimating time, software, insurance, vehicles, callbacks, storage, training, and the owner's unpaid administrative work. In this video, we will build a practical overhead checklist, convert annual overhead into a cost per productive hour, and show how one missing group of expenses can turn an apparently profitable quote into a loss. First, separate direct job costs from overhead. A direct cost can be traced to one job: the material installed at the customer's property, a permit purchased for that address, equipment rented for that project, or a subcontractor hired only for that work. Overhead supports the business as a whole. It exists even when no invoice is being produced. The first forgotten category is non-billable labor. Owners and managers spend time quoting, scheduling, purchasing, recruiting, training, handling complaints, reviewing jobs, and collecting payment. Office employees coordinate customers and technicians. A field employee may also spend paid time loading the van, driving, attending meetings, or returning defective material. If that time is not included in productive hour assumptions or overhead, customers never pay for it. The second category is vehicles and travel infrastructure. Fuel is only the visible part. Include lease payments or depreciation, commercial auto insurance, registration, repairs, tires, oil, tools permanently carried in the vehicle, parking, tolls, vehicle washing, GPS, and the time required to maintain the fleet. A service van can cost thousands per year before it reaches the first customer. The third category is insurance, licenses, and compliance. General liability, workers' compensation, commercial auto, professional coverage, bonds, license renewals, continuing education, background checks, safety equipment, inspections, and required record keeping all protect the right to operate. They are easy to ignore because many arrive annually instead of with each job. The fourth category is technology and payment infrastructure. Estimating software, scheduling software, bookkeeping, cloud storage, phone service, website hosting, email, cybersecurity, tablets, printers, and card processing equipment create small monthly charges that become a large annual number. Payment processing itself is often a percentage cost and should be modeled separately when it rises with revenue. The fifth category is customer acquisition. Advertising, lead platforms, referral payments, signs, uniforms, vehicle graphics, photography, review software, and the labor used to answer leads are not optional just because a job has already been won. The winning jobs must also pay for the leads that never became customers. The sixth category is facility and inventory support. Rent, utilities, storage, shop supplies, waste removal, security, cleaning, shelving, damaged inventory, small tools, and replacement consumables support every technician. A home-based business still has real space, electricity, internet, and storage costs, even if the owner chooses not to charge rent to the company. The seventh category is mistakes, callbacks, and warranty work. If 1 out of 20 jobs requires a return visit, that expected labor, fuel, and material cost belongs in the pricing model. Treating predictable callbacks as rare emergencies causes the profitable jobs to subsidize the unpriced repair work. Now calculate the overhead rate. Suppose annual overhead totals $216,000. The company has 3 technicians, but each one produces only 1,560 sellable hours per year after holidays, training, travel, meetings, and other non-billable time. That creates 4,680 productive hours. Divide 216,000 by 4,680. The overhead cost is $46.15 per productive hour. If the loaded labor cost is $43.33, the company has already spent $89.48 before job-specific materials, percentage fees, or profit. Now compare 2 quotes for a 4-hour job. Both include $200 of direct material. The incomplete quote uses 4 hours of loaded labor at $43.33. Its apparent cost is about $373. At a 30% margin, and the quoted price appears to be about $533. But the quote omitted 4 hours of overhead at $46.15. That is another $184.60. The true pre-fee cost is about $558. A price of $533 is already below cost. The business did not earn a 30% margin. It lost money while believing the job was profitable. The correction is not to guess a larger markup. Build an annual overhead budget from actual bills. Include a reasonable allowance for irregular expenses, and divide that budget by realistic productive capacity. Review the number every quarter and whenever staffing, insurance, rent, software, vehicles, or advertising changes. Use 3 checks before accepting the result. First, make sure owner and office labor appears somewhere. Second, use sellable hours, not total payroll hours. Third, separate fixed overhead from percentage fees, such as card processing or royalties, so the formula does not understate them at higher revenue. ServiceQuoteLab estimating tools are designed to keep direct costs, labor burden, overhead, fees, and target margin visible as separate layers. The collection is linked in the description. This is educational business planning content. Replace every example with your actual expenses, payroll, productive hours, fees, taxes, and operating conditions. No price, margin, or business result is guaranteed. Subscribe for practical service business pricing lessons. Next, we will calculate how to price travel time without making the customer feel punished for your drive.